So here you see what I would call optimal investment structure, a pretty simple version of that. Down at the bottom is what we call an operating company. That's actually your business. So whatever you think of as your business, that's what the operating company is. That's a company that has the office space, that has the commercial license. It's the company that is hiring employees, entering into contracts, just doing the business, right? But if you're going to be fundraising, you're generally speaking, with very few exceptions, are not going to be doing it at the level of your operating company. What you'll be doing is you'll be setting up, if you don't already have one, what we call a holding company, which will own 100% of your operating company. As part of your fundraising journey, there will be a point where you and your fellow co-founders, fellow early shareholders will no longer be direct shareholders in the business. You'd all sit up top. You see founders, team members, early employees or shareholders, or if you have an ESOP. And then investors will come in at that level as well. Both convertibles and funding round. It would all go through the holding company, and that holding company is what's going to own the operating company. And there's a number of reasons for that. I think the first one is it's always good corporate hygiene to be one step away from the messy business of running a business, right? That's where liabilities happen. That's where you might annoy a customer or you might have an issue with a supplier, et cetera, et cetera. So even though there's limited liability for the company, it's always nice if it's an extra layer and you keep your shareholding in an entity that's very clean, very passive, doesn't do anything really other than own another company and have obviously all the governance structures they have with your fellow shareholders. That's reason one. The more important reason is that any kind of professional investor, if you're talking about institutional funds, they have requirements as to where they're allowed to invest from a jurisdiction perspective. And it's quite narrow, right? So most professional investors, VCs, et cetera, they're not going to own shares directly in an onshore company or in a company that's in, Dubai Media City or DMCC or anything like that. Then what they're going to be doing is they're going to be saying, here are the jurisdictions that I'm approved to invest in. It's things like Cayman, DI, Delaware, potentially. So in the region, it's ADGM, Abu Dhabi Global Market, and the IFC, right? And that's because these jurisdictions are ones that they're generally speaking common law based, and they've got a track record of enforcing investor rights, but also your rights as well as business owner. And they allow for a lot of the concepts that we're going to be discussing here in terms of enforcing a conversion, different classes of shares, liquidation preference, governance issues, tag alongs, drag alongs, rights of first refusal, preemption right. Those concepts don't exist necessarily, or all of them don't exist necessarily in other jurisdictions. And there's that track record. Okay. There's this has been happening. We see disputes, we see court cases, we see enforcement, we're holding our rights in that. So that's the optimal investment structure. And as I said, it's even if you're just doing a state per convertible, this is something you probably will have to move to if you're raising from institution, professional capital.